Okay. Good evening, everyone. Good evening, all the students present over here and attending this session, um, which is about a revision about the topic of cost of capital, which is a topic in CA Inter paper uh, 6A, right? The first paper in the sixth section. So, cost of capital, we have, I think, revised ratio analysis and other topics also. And now we have to revise this topic of cost of capital. Now, when we look at this term of cost of capital, we are already aware about the formula and all. So the agenda that we are going to set out for today is we'll be revising the concepts that we have in this topic, and then we'll be taking up the case scenarios. Case scenarios are already uploaded on the BOS portal, so you should be able to download it. Okay, from there, the questions are available over there. Now let's get started with the cost of capital. So the idea over here is a business entity actually gets money from multiple sources. It could be equity, it could be reserves, it could be your preference shares or debentures. And then those those amount of money which is collected, that's invested into multiple projects. So now, let's say you want to evaluate one of the project with a promised return of 12%, right? Now, whether I should be investing in this or not, that actually depends on how you have raised the money and what is the cost of the money that you have raised. And so that's important to know what's the cost of each one of them, right? And the cost of each one of them will be computed. And we say that if our cost of the funds that we're getting, if it's lower than, if the cost of funds is lower than the return that we're getting from the project, then it makes sense for us to accept the project for the decision making, right? So it's essential for us to calculate the cost of capital. And remember, whatever cost of capital we are computing, that's always going to be in the terms of percentage per annum. So first up, it's going to be calculating the cost of debt, then cost of preference shares, then cost of equity, reserves, and then finally weighted average cost of capital. We're aware that cost of debt can be computed with this particular formula, which is interest into 1 minus t plus redemption value minus net proceeds by n, and then the whole thing divided by redemption value plus net proceeds by 2. Right? So this is the approximate method, and also the irredeemable debentures can be computed as interest into 1 minus t upon net proceeds. Okay, since it is an irredeemable debenture, no redemption is going to happen for these debentures. Okay, then similar way, cost of preference shares is preference dividend plus RV minus NP upon N, the whole divided by RV plus NP by 2. Right. So this is similar to the cost of debt, but the only thing is you don't have any tax benefit coming up over here. So cost of preference share for irredeemable preference share is preference dividend upon net proceeds. Okay. Then there's another method called as the YTM method, right? Or the yield to maturity method, or the IRR method, wherein we simply calculate the IRR by equating the present value of cash flows with the current value, right? So for example, we have the face value of debenture as 1,000, issue price is 980, redemption value is 1050, term is 5 years, coupon is given, flotation cost is given, net proceeds we can definitely compute by subtracting the flotation cost from the issue price, and tax rate is 30%. So from a company's point of view, the cash flows are going to be like you receive 931 and then you pay 70, 70, 70, and finally you're also paying out 1120, right? So that's the cash flow which is happening, right? So now we want to know what's the IRR or YTM of this particular thing, or the cost of capital, cost of debt on this. So we simply discount, or I can say we'll first initially calculate the approximate cost of this. So we can say that 931 should be ideally present value of all these cash flows, right? So it should be like the present value of 17 first year, 17 second year, 17 third year, 17 fourth year, and 1120 in the fifth year. So we discount it at 10%, we find that it is 917, and then at 5% we find that it is 1125, and then we do the interpolation between both of them, right? So this is something which we also do while calculating IRR in the capital budgeting chapter or the investment decision chapter, right? So at 10%, you have the value as 917.32. At 5%, it's 1125.77. So we see that the change in the value is negative 5%, or percentage change in the value is negative 5%. And the value of the bond is 208.44. That's increasing by 208.44. So percentage change that we see from 208.44, we just add to it 13.68, because we want to make it from 917 to 931. So that's 13.68. And then we do the cross multiplication to arrive at the differential number. And that differential number is essentially subtracted from 10%, which will give us the cost of debt on approximate basis. Same way, we even do it for the preference share on approximate basis. But the other part that we're looking to address is the calculation of cost of equity. So cost of equity, it's simply going to be either of these approach. Either you can get it by way of dividend price approach or earnings price approach or dividend growth approach, or it could be realized yield, and it also could be the capital asset pricing model. So dividend price approach, we say KE is dividend upon price, right? So cost of equity is dividend upon price, right? And cost of equity over here in earnings price approach is EPS upon NPS. And when we have a constant growth rate happening, then we see that P0 is D1 upon KE minus G, right? So definitely KE is going to be D1 upon P0 plus G, right? Realized yield approach, you can say when it comes to realized yield approach, you actually calculate uh, the rate at which the present value, I mean, at which the future present value of cash flows is going to be equal to the current price. One second. Sorry, yeah. There was a query, I think. Anyways, yeah, I think you can see the query over here also. So flotation cost will always be on issue price if issued at premium, then deduct as a percentage of premium value. Yes, Asta, you're absolutely correct. Okay, so realized yield approach, wherein we see what are sort of cash flows that we get uh, from uh, the purchase of shares. So let's say you bought a share for 1,000, and against that, you are essentially getting paid with these sort of dividends, and when you are selling the uh, share or at 1,400. So what's your rate of return that you have? It's simply calculating the IRR and nothing great out of it. Okay. One important approach that we have in the calculation of cost of equity is calculation using the method called as capital asset pricing model, or CAPM. So under CAPM, we simply calculate by taking into account what's the risk-free rate, what's the beta, and what's the premium that we have in the market. So our cost of equity is, simply K is equal to RF plus beta into RM minus RF. Okay. So that's your CAPM model. Cost of earnings, most often it's going to be same as of your cost of equity, because that's the money of the equity shareholders. And weighted average cost of capital is something that we calculate by simply taking the weighted average. Now, the weights can be calculated either on the book value or on the basis of the market value. In realistic scenario, we definitely use the market value to calculate the weightage. Okay. And then there are certain other concepts also. Let's say you want to calculate the realized yield using geometric mean method. So you have the prices given over here and the dividend per share. So you calculate the rate of return every year. So first year 19.44, second year 28.21, third year 6.09, and then you have 7.73. So you can get the geometric mean return by simply compounding it every year. So 1 rupee grows by 19.44 in 1 year. Again, it grows by 28.21. Again, it grows by 6.09, and then by 7.73. So it keeps on growing, and that's totaling to like 1.7501. And you can essentially say that this is the compounded value of 1 rupee. Get the rate of return accordingly. Okay, so then after that, we definitely had certain questions to discuss. Now, we'll take up the case scenarios for revision purpose. So now, my again, the questions goes to the same. Goes to the question which goes to you. That remains the same. Would you like to solve those case scenarios, or do you want me to solve it? Yeah, guys. What would be your preferred action? Just give me a moment. I'm opening the file. Second. Scenarios intermediate. We asked us what explain geometric mean method. Well, geometric mean method, it's the method by which you compute the rate of return. So that's a method by which you're computing the rate of return earned, and that's applicable like if you're earning the return, uh, over multiple periods. Then how do you understand? What's the rate of return that we have earned on an overall basis. So, like, let me just share the screen again so that we'll be able to discuss it. Okay, so geometric mean, it's like you compute the rate of return for each of the years of your investment, like year one, year two, year three, year four. Right? So you compute the rate of return for each of the years of investment. And then you say that overall, what's the rate of return that you have earned in the total in its totality. So like over a period of 3 years, what's the rate of return that you have earned? Or over a period of 4 years, what's the rate of return you have earned? So 1 rupee becomes 1.1944, then it again grows at 28.21%, again grows at 6.09%, again grows at 7.73%. So this keeps on growing, and this value is the maturity value. So every year you compute the rate of return, and when you want to calculate the geometric mean, you simply take the fourth root of this. Like over here, we know amount is equal to principal into 1 plus I raised to n. So amount is 1.7501 is equal to simply 1 plus I raised to 4. So I can get the rate over here as 1.7501 raised to 1 by 4 minus 1. So it's 1.7501 raised to 1 by 4. So that's 15.018% or 15.02%. Right? That's your rate of return. That's the geometric return that we are talking. Clear? Basta? Are we good? Okay, fine. So now let's go for the discussion of case scenarios. This booklet is already there on the viewers portal. You can access it from there, but for regarding the question. But yeah, which questions do we do right now? That's what we are going to discuss over here. Okay. So let's look at this case scenario number 3, guys. Case scenario number 3. Would you like to try to solve it on your own first, ways, and then we'll discuss it? Yeah. Would you like to solve it on? We'll first try and then we'll discuss it. Or are we planning, or shall I simply take up the question for you? Will you solve it? Everyone? Yeah, Asta. Yeah, screen wider. Is it sufficient now? I think you will be also able to zoom it in your screen also. Okay, fine. Give it a try, guys. Try to solve it. Okay, fine. So ABC Limited is a manufacturing company that finances its operations through a mix of equity shares and long-term debt instruments. Company's capital structure consists of 1 lakh equity shares of rupees 10 each and 6,000 debentures of rupees 100 each, carrying interest rate at 10% per annum. Management of ABC Limited is currently evaluating its overall cost of capital in order to assess the feasibility of upcoming investment projects. Since the company shares are actively traded in the market, the finance manager decides to use the capital asset pricing model to determine the cost of equity, considering the risk associated with the company's equity shares in comparison to the overall market. The following market related information is available. Risk-free rate is 4%. Expected market return is 10%. Beta of ABC Limited's equity shares is 1.6. In addition, the company's cost of debt is known to be 10% before tax and corporate tax rate is 30%. Based on the given data, answer the following questions. Now, first up, what does the beta value of 1.6? Now, when you say beta value of 1.6, it means your stock is 1.6 times riskier than the market. So we can say stock is volatile. Stock volatility is equal to market? No. Stock is moderately volatile. No, stock has got high volatility or low volatility. We can definitely say stock is having a higher volatility because when you say beta 1.6, it is 1.6 times or 60% more volatile than the equity. Okay. So first answer is D. Since it's 1.6, it means it's more volatile than the market because beta of 1 means it is same risk as that of a market. But here, when we say that a stock is, beta is 1.6, it means having a higher volatility. What's the formula for CAPM? That's going to be risk-free plus beta into market rate minus risk-free rate. Risk-free rate is beta. Obviously, answer A. Third one, what's the cost of equity? Now, for cost of equity, we have the risk-free rate as 4%, right? We have the risk-free rate as 4%. Expected market return is 14 and beta is 1.6, right? So that's going to be simply 4% plus 1.6 into 10 minus 4, right? So that gives us answer as what? 10 minus 4 is 6, 6 into 1.6 plus 4%. So answer is B. Is it 13.6? Right, so it's going to be 4 plus 1.6 into 10 minus 4. So when you say 10 minus 4, that is essentially 10 minus 4 is 6, 6 into 1.6, and then plus 4. So that's 13.6%. Yes, option B. What is the cost of debt after tax? Cost of debt after tax, since it is 10%, that's going to be 10 into 1 minus 0.3. So that's 7. What's the weighted average cost of capital then? So for weighted average cost of capital, we need to look at the company's capital structure comprised of equity shares and 6,000 debentures. So weightage is what? 6 lakh and 10 lakh. So 10 is to 6 is the ratio. So 10 out of 26 into 13.6 plus 6 out of 16. So this is what? Once again, 10 out of 16. That's the weightage. 10 out of 16 into 13.6 plus 6 out of 16 into 7. So what's the weighted average cost? It's 11.125. Correct, guys? That's 11.125. Okay, when you say that low and moderate volatile, when you say moderate volatile, it's going to be 1, that beta is 1. And if beta is less than 1, then you will say that it's having a lower volatility. Got it? Asta, got it? Yeah, even 1 you can say, even if it is 1, then you can say it's equal to market. Okay, so moderate and equal to, it's going to be the same. Okay, fine. Let's take up then another question. Yeah, this question, guys. Yeah. Try out this question. Flotation cost will be deducted from net proceeds of market price and dividend yield approach. Flotation cost will be deducted. Yes, Astha. Dividend flotation cost needs to be deducted. Sure. Give it a try. Next question, next case scenario. Try to solve it. I'll give what around 10 minutes for this. Okay, so let's look at this case scenario 9 now. So we have a company which is having a capital structure that consists of equity share capital, reserves and surplus, bank term loan, debentures which are redeemable at a premium of 5%, and preference share capital redeemable at a premium of 5%. The coupon rate uh, on debentures is 1.5 times of that of term loan coupon rate, whereas the preference given rate is 1.5 times of debenture interest. Tenure for bank term loan and debentures is 3 years, 5 years, and 7 years. The current book value of capital structure is given: equity share capital, reserves surplus, term loan, debentures, preferences. The rate tax rate is 25%. Debentures are currently selling at a price of 96, whereas preference shares are currently selling at 102. So the equity shares of company are quoted at 150 per share. The ongoing PE ratio for the shares of Paramus Limited is 6.667, and it belongs to risk class where the overall capital discount rate of the company is 20%. Now, based on the given information, you're required to answer the following questions. First up, based on capital structure proportions, the interest rate on bank term loan. Now, based on this capital structure proportions, what's going to be the interest rate on term loan? So we can see uh, coupon of debenture is 1.5 times that of the bank term loan coupon rate, whereas preference rate is 1.5 times of the debenture interest rate. Now, debentures are redeemable at a premium of 5%, and preference share redeemable at a premium of 5%. Both of them are redeemable at 5%. Now, how do we get the interest rate on the bank term loan? Interest rate that's applicable on the term loan of a bank. So, tenure and all we have. Now, interest rate we can take the bank term loan interest rate to be X. So, let us consider the rate of interest on the bank term loan be X, and therefore interest on debentures is 1.5x, and rate of preference share will be 1.5x of 1.5x. So these are the rates that we have for debenture, bank loan, and the preference dividend. And then after that, let's calculate the cost of debt, which is term loan. That's going to be interest into 1 minus t, which is x into 1 minus t. So that's 0.75x. Cost of debentures is going to be calculated by this particular formula. Okay, where the redemption value is 105 because it's at 5%, and net proceeds is 96. Now we don't know what's the interest rate of the debenture, so we're going to take it as 1.5x, right? So 1.5x, that's the rate of interest. So 1.5x into this, so it's going to be like 1.5 times of 100. 1.5 times of 100, 150x into 1 minus 0.25. This is a form of calculation effect, and we see that the cost of debentures is going to be in this pattern. Same way you get the cost of preference share, and then we have the KE as 1 upon P ratio as 15%. And now the only way to get it is to calculate the weighted average cost of capital. We have equity share, we have the values of each one of them, so we can get the weights. Costs can be, equity share and reserves are still at 15%, but bank term loan, as we computed, it is 0.75x. Debentures is going to be this number, cost of debentures 112.5x plus 1.8 divided by 100.5, and same goes for the preferential. If you have the cost stated over here in terms of x, and then we do the weighted average, that weighted average is going to be definitely equal to 20%. So you solve this equation and get the value of x. So that's the rate of interest on the term loan. And once you get the rate of interest applicable on the term loan, you can actually calculate the interest rate on debentures and also the preference dividend rate. Right. So that's the pretty simple part to calculate. Okay. And the last part is also to compute the back using market value. So once you've got the individual costs, now you can definitely take the market value weights to calculate the overall cost of capital or weighted average cost of capital. So quite a challenging question because you need to first assume, because once you open up the first question, rest all questions will be able to get it easy. Okay. Are we good, everyone? The only part is, to get it started with X. To assume the rate of interest on term loan as X, then you get the rate of interest on debentures, then the rate of preference dividend, and all other calculations follow. Are we good, everyone, with this? Quite a mathematical problem or a case study over here. It wasn't much conceptual, but yeah, it's testing your mathematical or arithmetic abilities. Yeah. Shall we go for the next case study now, guys? Shall I take up the next one? Yep. Next case study. Shall we take up the next one? It's just a small case scenario. Just one question. So try out this question number 13, guys. Try question number 13 or the case scenario number 13. Try to answer this. Yes, in preference dividend formula, we will take X dividend and not cum dividend. We will take X dividend. True. So in equity and debt also, ex dividend and ex interest. Of course, yes, it has to be ex dividend and ex interest. Now, ABC Limited has the following capital structure based on the market value. So we have equity 60 lakhs and debt market value is 40 lakhs. Cost of equity is 14%. Cost of new equity after accounting for 5% rotation cost is 15%. And cost of debt is 10, corporate tax rate is 30%. Company plans to raise additional capital by issuing new equity instead of using retained earnings. The capital structure will remain unchanged. What will the impact on the weighted average cost of capital? Okay. So now currently we have equity and debt with 14% and 10%. Uh, Now, what's going to be the impact on the cost of equity if you're going to raise additional capital by issuing new equity instead of using retained earnings? So if you're going to issue new equity shares, the cost of equity is anyways going to be, initial WACC using retained earnings, it would be like 60 out of 100, 14 into 14% plus 40 out of 100 into 10 into 1 minus T. So currently your initial WACC is 11.2. Now, if you're going to replace your retained earnings with new equity, the new equity is going to cost you 15%. So now the weighted average cost of capital is going to be, of course, 11.8%, guys. So weighted average cost of capital is 11.8%. So 11.2, it will increase from 11.2 to 11.8%, which is option A. So that's absolutely option A correct, which is WACC will increase. In fact, even if you don't calculate it, the answer would be, 11.8% quite simply because retained earnings are costing less, whereas new equity shares are costing a bit higher, which is 15%. Right. So therefore, we say the weighted average cost of capital is going to increase to 11.8%. Okay, fine. So with that, let's just take a break right now of 15 minutes, and then post break we will start discussing about the new, maybe couple of more case scenarios. Okay, let's take a break now, guys. Right? So Kuldeep is asking, can you give some explanation about accounting for 5% flotation cost? Basically, this is like when you're issuing new equity shares, you need to also incur expenses for flotation cost. You need to incur expenses for flotation cost. So those flotation costs have been considered when we calculated the cost of equity. Okay. Asta is asking, there are 5 years. 5 years, but we have computed return for only 4 years. So prices may be of 5 years, but returns have been computed for only 4 years. Okay, fine. So let's take up another one for case scenario discussion. Okay, look at this question. Yeah, try out this question. Try to solve this question, guys. Asta is asking, not given in question how many years return to compute. How many years return to compute is not given. It's always geometric mean is per annum basis. So whatever is the number of returns you have, like if you have returns for 4 years, then it has to be raised to 1/4. Okay, try out this one on cost of capital. So, I'm not giving question, how many years return to compute? Uh, See, Vincent, when we have 5 years data, Asta, I can calculate return for only 4 years. How will you get the return of the first year? Because for first year return, you need previous year price, right? So when you have price of 5 years, you can calculate return for only 4 years. And therefore you do it in that way. Okay. Okay. Additional Capital Kalyana Limited has an operating profit of 34 lakh 50,000 and has employed debt which gives total interest charge of 7 lakh 50,000. The firm has cost of equity and cost of debt as 8%. The firm has a new proposal which requires funds of 75 lakhs and is expected to bring an additional profit of 14 lakh 25,000. To finance the proposal, the firm is expecting to issue an additional debt at 8% and will not be issuing any new equity shares in the market. Assume no tax culture, you're required to answer the following questions. So there's no tax. So we are requiring a funding of 75 lakhs, right? And this is going to provide an additional profit of 14 lakh 25,000. So we are supposed to be issuing debt at 8% without any issuing equity shares. You have to compute like weighted average cost of capital before new proposal. So we have weighted average cost of capital before new proposal. How do you get the before new proposal? Because uh, has operating profit and debt, which gives an interest charge of 7 lakh 50. Firm has cost of capital. And how do we get this weighted average cost of capital? Because um, so when we want to compute the weighted average cost of capital, I'll need the amount of equity, right? And also the uh, debt, and then we take a weighted average of it. So we need to first get the value of equity capital. Now, for that purpose, since we have this profit of 34 lakh 40,000 and interest charge of 7 lakh 50, so 34.5 minus 7.5, that's going to be 27. Okay, so 27 lakh is the amount of profit or profit after tax that we have, and the cost of equity is 16%. So value of equity will be 27 divided by 0.16. So value of equity comes out to be this number, which is 1 crore 68 lakh 75,000. And value of debt can be obtained as 7 lakh 50,000 divided by 8%, which is 93 lakh 75,000. So we get the value of equity, value of debt. We calculate the weights, and the cost is given as 16 and 8%. So we get the 16 and 8%. And then the weighted average is 13.15%. Now, calculate the weighted average of after the new proposal. This is basically before, it's stated to be before, but we are looking to calculate this as a after the new proposal thing. So after the new proposal, the value of debt is going to increase by 75 lakhs. So 93 lakh 75,000 will be added with 75 lakhs. So that's 1 crore 68 lakh 75,000. The weightage is 0.5. And then we take the cost of capital or cost of debt is what? 8. Right? And then you calculate the weighted average, which is going to be simply 14.5%, which is option C. Right? So it's a pretty easy question. Just a bit of, presence of mind is required for this. And of course, the cost of equity is going to change here because your profit is going to increase and also the interest is going to increase. So I need to compute the new cost of capital, keeping the market value as constant, because as you are increasing debt, the equity shareholders are going to face more risk and therefore their cost of capital is also going to increase. Okay. Then, yeah. This question, guys. Case scenario number 2. Yeah, case scenario number 22. Try out this question, guys. Hmm. Try to solve this case scenario. It's a bit challenging one. So just be careful. So here we have this question. Tiago Limited is an all equity company engaged in manufacturing of batteries for electric vehicles. There has been a surge in demand for their products due to rising oil prices. The company was established 5 years ago with an initial capital of 10 lakh. And since then, it has raised funds by IPO, taking the total capital up to 1 crore. So right now, the capital that's invested in the company is 1 crore. The company currently has undistributed reserves of 6 lakh. So out of total, in paid up capital is 1 crore. Additionally, we have undistributed reserves of 60 lakhs. The company has a following constant dividend payout policy of 40% of earnings. The retained earnings by company are going to provide a return of equity of 20%. So company is having a constant dividend payout policy of 40% of earnings. Retained earnings by the company are going to provide a return on equity of 20%. Current EPS is estimated as rupees 20 and prevailing P ratio on the share of company is 15x. So we have the EPS as 20, P ratio is 15x. Retained earnings provide a return on equity of 20%. Constant dividend payout policy is given, so we know what's the retention ratio. The company wants to expand its capital base by raising additional funds by way of debt, preference, and equity mix. The company requires an additional funds of 1 crore 20 lakh, guys. The target ratio of owned to borrowed funds is 4:1. Post the fundraising activity, capital gearing is to be kept at 0.4x. The target ratio of owned to borrowed funds is 4:1. So target ratio, basically owned to borrowed funds, basically owners funds or shareholders funds to borrowed funds, the ratio is going to be 4:1. Post the fundraising activity. So after fundraising activity, this ratio should be relevant. Capital gearing is to be kept at 0.4x. The existing debt markets are under pressure due to ongoing RBI action on NPAs of the commercial bank. Due to challenges in raising the debt funds, the company will have to offer rupees 100 face value debentures at an attractive yield of 7.5% and a coupon rate of 8% to the investors. Okay, and a coupon rate of 8% to the investors. Issue expenses will amount to 4% of the proceeds. So issuing expenses are going to be amounting to 4% of the proceeds. The preference shares will have a face value of 1,000 each, offering a dividend rate of 10%. Preference shares are going to be issued at a premium of 5% and redeemed at a premium of 10% after 10 years, at the same time at which debentures will be redeemed. CFO of the company is evaluating a new battery technology to invest the above raised money, and the technology is expected to have a life of 7 years. It will generate a after-tax marginal operating cash flow of 25 lakhs per annum, and we assume a marginal tax rate to be 27%. So marginally, the tax rate is going to be 27%, guys. I want to compute which is the best estimate of the cost of equity. Now, when it comes to cost of equity, we can definitely take D1 upon P0 plus G. Do we have the information to calculate the value of G? Yes, we have. Dividend payout is 40%. So retention ratio is 60%, guys. Right, retention ratio is 60%. Earnings are going to be reinvested at a 20%. So growth rate is going to be 60% into 20%, which is 12%. So growth rate is 12%. We got the growth rate number. EPS is 20. And of course, you can get the D1 value. You can get the D1 value, which is dividend. So retention ratio is 0.6, and then we said return on equity is 20%. So DPS is 8. Market price per share, since there's a P ratio given to us, growth rate is computed. And now we can get the KE as what? D1 upon P0 plus G, which is 14.99%. Absolutely correct, guys. Then is the most accurate measure of issue price of debentures. Now, when it comes to debentures, due to challenges raising the fund, the company will offer rupees 100 face value debentures at an attractive yield of 9.5% and coupon rate of 8%. Issue expenses will be 4% of the proceeds. Okay, so issue price of debentures is going to be, simply present value of your coupon discounted at 9.5%. So it's going to be 8 into present value annuity factor at 9.5% plus 100 into present value factor at 9.5%. So that's going to be like 90.58. That's 90.58. Which of the following is the best estimate of cost of debentures to be issued by the company? Use the approximation method. Now, since we have the price of the debenture as 90.58, that 90.58 is your price, or we can say this is your net proceeds. Net proceeds is 90.58. The redemption will be at 100, right? Net proceeds will be 90.5 minus 4%. So net proceeds will be 96% of 90.5. Redemption value is 100. Interest rate is 8. And we can definitely simply use the cost of debt formula, the approximate cost of debt formula. Same way, we can calculate the preference share cost. Preference share cost is going to be, they're having a face value of 1,000 each, offering a dividend or rate of 10%. Preference share will be issued at a premium of 5%. So, issue price is 105. Redeem at a premium of 10%. So 110 is the redemption price. And after 10 years, at the same time at which the debentures will be redeemed, the preference shares will have a face value of 1,000. So I can get the preference dividend as 100. Redemption value is 1100 minus net proceeds is 1050 divided by 10. And then you take a denominator as the average of both. Which of the following best represents the overall cost of marginal capital to be raised? Now, marginal capital is simply going to be the additional capital that we are raising, which is to the tune of, the total money that we are raising, the additional one, right? Because I need to look at this ratio. The ratio that we need to maintain is that the target of owned to borrowed funds should be 4:1. So owned to borrowed funds, owned funds to borrowed funds should be 2:1. Sorry, 4:1, and capital gearing is supposed to be kept at 0.4x. So we use these ratios, like existing is 160, and we are getting an additional of 120. So total is going to be definitely 280. So this total 280, it's going to be 56 and 224, and distribution will be done using that capital gearing ratio. And then you use those weights to calculate the weighted average cost. Okay. Simple. So we need to first look at total, it is 280 like this. Total is 280 lakhs. Right. So out of this total 280 lakhs, we need debt and equity. Debt and equity. And we have the debt equity ratio is 4:1. So this is 4:1. So debt equity is 4:1. So the distribution happens like so 280 divided by 5, which is 56 is your, debt equity. It is what? Owned to borrowed. Okay. So this is, let's say, equity and this is debt. So 56 is debt and this is 224 is equity, right? Or owned funds, right? So out of this 224, we need to further look at the capital gearing ratio is 0.4. The capital gearing ratio is 0.4. So 56 plus preference share upon what is that? 224, sorry. 224 minus preference share, this should be equal to 0.4. This is 0.4. So you need to simply solve this and get the value of preference share, which is going to the balancing. And then equity share is left out, and then you get this additional Now, based on these additional ratios, you get the weightage as 40, 24, and 56. Take simply the weighted average for the marginal cost of capital. Are we clear with this question, guys? Are you clear with this question? So return the net expected dividend on equity shares is 2 per share. The dividend is expected to grow at 5%. It has taken DO as 2 and then D1 as 2 plus 5%. What's your D should be? Okay, once again. Here it is said EPS is 20 and the prevailing P ratio is this. Dividend payout is company has been following constant dividend payout. The current EPS is estimated at rupees 20. So current EPS means current year EPS. So current year, not that question. Then which one? Previous year. Which one you are saying previous year? Which previous year you are saying? Previous question or previous year question paper? Okay. So you are saying that it is comprising of dividend is expected to grow at a rate of 5%. When D1 is 1, but sir, D1 should be 2. The net expected dividend on equity shares is 2 per share. Is it net expected or next expected? You are saying that net expected dividend or next expected dividend? Net expected dividend. So net is basically expected is current year. So if the question says that expected dividend after a year, expected dividend after a year, then you will take it as D1. But when you say expected dividend is going to be what you're expecting right now. Okay, so if it is next expected dividend, then you have to call like, maybe at the year end. So now let us take one last question. Okay, try out this case scenario 26th now, guys. Try out this 26th. Okay, so are we done, guys, with this? So we straightforward have the numbers in front of us. 9% debentures, 11% preference shares, equity shares, total capital is given, and then we have debenture, preference share, and equity shares price and interest cost, flotation cost is given. So you want to compute the cost of equity. So cost of equity can be simply computed by the Gordon model, which is D1 upon P0 plus G. So that's option B. And second question is calculation cost of debt. Cost of debt, again, we know this typical formula. So we have the numbers, we just need to substitute. Same goes for cost of preference share also. And then calculate the WACC using market value weights and choose the correct answer from the following. So when you say weighted average cost of capital, I need to have the cost of equity, debt, and preference share. And the market values are used to calculate the weights. And finally, what will be the current market price of equity shares if K is 10% expected? This is a separate question where you have the D1 value, we know the K and G, and we can get the market price of the equity share. Okay. In the question, 100 per debenture renewable par has a flotation cost of 2% and 10 years of maturity. The market price per debenture is 100, and in this ICAI is taking a net proceed 98. Can you go for 110 less flotation cost? No, because we are calculating here. Um, it's what? Redeemable market price is 105. So we have taken 105, right? Yeah, in the previous year, okay, the market price per debenture is 110. In this case, I has taken 98. Market price of debentures, okay. Can we go 110 minus flotation cost? Yes, you can do that. Yes, you can take it up. Because then the question should be asking you, what should be the cost of preference shares? Like, okay, if you have the new prices, you can use the new prices anyways. Okay, so with that, we are completing the revision for the cost of capital chapter, guys. So let's just stop here for the day. See you another day. Uh, Probably we have the session on 29th. Right there, we are going to take up the next chapter. So till then, take care, guys. See you in the next class. Bye bye. And yeah, Asta, if it's next dividend, then it is D1. Yeah, true. Correct, Asta. Okay, so let's just stop here for the day. See you in the next class, guys. Bye bye. Done, done.